Welcome to TheoTRADE. This is Don Kaufman. It's March 28th, 2025. Just about 30 minutes stand between us and the cash close here on another wild Friday afternoon. The S&P's down some 2%. The NASDAQ possibly facing a 3% loss. Wouldn't be surprised at all to actually see some sell-side activity coming in, to this 30 minutes into the cash close here. So again, some 530 handles off the NASDAQ today, cracking under that 20,000 level again. Look, let's explain it all here on this TheoTRADE weekend update. Get ready. Another wave of risk is imminent. Let's get right to it here. So as I was saying moments ago, the S&Ps are down about 115 handles. Everybody looks at this, they're like, oh man, this one came out of the blue. It didn't come out of the blue. There are actually great signs of this. In fact, I was talking about them not only in last weekend's update, but I was talking about it on Wednesday as well. Last weekend's update, it was all about like volatility compression and, get ready to rumble. But you need only look at the SPX. In fact, I'm going to start in the SPX, and just deliver to you, all right, a couple of aspects over here. When I start talking about volatility compression, that was the name of the game, of course, last week. In fact, that was last week's update was all about the volatility compression. Get ready to rumble. We explode back to the upside. There wasn't much of a rally. Last week wasn't much of a rally, but that rally really kicked off on Monday. On Tuesday, we flattened out, but really this entire week kind of came down to edges of expected. So what we did is we cracked to the upside on Monday and went right into the upper edge of the expected move. On Tuesday, we rode the upper edge of the expected move. On Wednesday, we're riding the upper edge of the expected move to the markets had a precipitous break lower. And that is when you knew it was going to get crazy, and it was going to get crazy in a hurry. And that's exactly what I was trying to deliver to you on the Wednesday, afternoon update. Obviously, coming into this Thursday and Friday, volatility just kind of erupted. And look where we are right now. So wild week. We actually hit the upper edge of the expected move in the SPX. And right now, we're sitting just off the lower edge of the expected move in the SPX. For those of you that do tune in on a week-to-week basis, and for those of you that receive our trade communications, our trade updates, we actually traded an SPX butterfly. And I traded that butterfly yesterday looking for a move to the lower edge of the expected, and we hit it. We actually hit it, and I'll talk about it a little bit more. I happen to still have some contract size on. The contract size I have on right now, I'm literally up over 1,000% on the contract size I have left on. So maybe during the course of this video, I might be exiting that particular trade. Again, we are literally 1,000% better off than we were yesterday when I originally put the trade on. I had closed the trade, or I should say a portion of the trade earlier the day for a 500% gain, but I'm sitting, another portion of it. And what am I looking for? Well, actually this is kind of great here because 28 minutes to go and you're just, a hop, skip, and a jump above the lower edge of the expected move. Let's see the markets actually drive into that lower edge of the expected move, in this time period. All right, as I said, let's get down to business though. One of the first things I want to do is bring up the S&Ps again, because where are we trading? To give you kind of orientation, I like to use a 30-day 1 hour. I like to use a 30-day 1 hour, and I think it's incredibly important if you're going to look at S&P futures, to come in here and adjust for contract changes, hit apply, hit OK. So timeout. This tells a fairly critical story, and the critical story here is, obviously we're delivering you some pretty big sell side activity. The market actually compresses in volatility, pops back to the upside, which you would expect, and here we are. And right now, look, get ready for another wave. Another wave of what? Well, we have not today cracked through lows, and that's pretty critical. That you got to realize that some sell side activity, things are getting crazy. But we're not at lows, but we're fairly close. So one of my assumptions in last weekend's video was, and by the way, I got a lot of emails about this one, both negative and positive. By the way, the emails, it's not going to change my trading strategy or my thought process at all, but I do appreciate them. But there were a lot of emails like, are you crazy? We're not going back down to retest lows. Okay. I was very definitive in last weekend's update. We're going down. We're going to retest lows. So in effect, we're there. We're close. We're not home though yet. We're not home. And one of the things I'm going to point out right now, hedgers are stepping back up. They're re-upping some of the hedges, which I'm going to show you, which again, there's times where, oh, tell me which way we're going over here. I am. Like, what do you think I did last weekend? I said, just get ready. Okay, we're going to pop and then we're going to drop. That's what volatility is about. You get wild and woolly two-sided trade. And here we are with wild and woolly two-sided trade right now. But I think you need to anticipate that this 55.50 in the S&P futures. Now, I'm talking about S&P futures. You're 70 handles off what would be a new bottom. But if we do crack through that, okay, and there's a big if in there, that's okay, right? If we actually crack through this 55.50, well, holy crap, you're going to see some fireworks in this marketplace, because that, people, is when the volatility will absolutely erupt at that point. So you see that volatility took back off, but it really only took back off today. So why hasn't volatility? It should be rocking to the upside. No, it shouldn't be rocking to the upside. Yes, volatility is picking up. Yes, volatility is displaying that risk is coming back in, but we've already seen this movie before. We've already printed in the S&Ps, and this is so important because people look at this and they're like, wow, but what? You've already seen lows in here, okay? So I scribble on the screen over here. You've already seen lows. The shock and awe of hitting, 55.50 has already happened. So the second time through, okay, the VIX is going to be like, oh, I've seen this movie before. It's going to take, okay, again, some shock and awe for that thing to really go parabolic. And that is, you're going to have to cross through 55.50 and you're going to have to do with some fireworks. Okay. And you need to be prepared for that, because I'm going to tell you what, there are some signs on the screen that others are actually preparing for it. So that is the first thing, is like, look, another wave of risk right now. It does appear to be imminent. And that's not intended to scare anybody. That's just, plain and simple. Like, you're looking at this. In fact, let's cruise over to the spider. Sometimes spider charts are a little easier. You're real close to lows, but you haven't matched lows. And some people are like, it could be a double bottom. Sure, it could be a double bottom. I can't see that. Okay, but I can tell you, okay, there's a really high probability of retesting, okay, not into lows, but actually crossing through them. Incredibly high probability right now. A lot of that probability, of course, is going to be based. Let's move into our first bullet over here on vol backwardation. So we're back to backwardation. It's not a huge backwardation, but it's real. Okay, there's no question about it. I've talked ad nauseum at this point about volatility and backwardation. What it basically means is we're in the throes of risk right here, right now. And I know a lot of people are going to talk about, but the tariffs on April 2nd. Look, nobody wants to wait till April 2nd. Don't you get that? That's what this marketplace is about. Nobody wants to wait. Okay, and we're already basically talking about tariffs, and Europe is basically backing down maybe a little bit already. Okay, but I would be nervous going into this weekend long this marketplace. Apparently, so is everybody else, especially when we're in the midst of backwardation. And for those of you, again, if you've not understood backwardation, I've covered it in detail in so many different videos. But what it basically implies is short-term risk is now exceeding some of the longer-term risks, and that, again, it indicates you're in the throes of a much more serious, implication of a move. Now, that being said, it doesn't necessarily mean like, we're going down. That unto itself doesn't mean it's going down, but it changes the nature of the beast, and it changes how market-making firms actually offload risk. So it actually creates a little bit of a feedback loop, because the higher the volatility goes, the more the trading firms have to sell S&P futures, and the more they sell S&P futures, the higher the volatility goes. So you start getting a feedback loop between volatility futures and the S&Ps. And that's one thing that, like, the VIX does not display, because the VIX is just an equation, but the volatility futures are a real, tangible, tradable product. Okay, you can taste them, you can touch them, you can love them. Anyway, that we're back to volatility backwardation, which means we're in another wave, okay, of risk. Now, To further that, let's look at the bond market. So it's been a while since the bonds have displayed much of anything, but I'll make actually a very distinct point. This morning, okay, even before the PCE data came out, yeah, there was PCE and the PCE data came out right there. PCE is the Fed's inflation indicator of choice. Inflation is still stubborn. It actually came in a little bit hotter than expected, yada, 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 okay? I don't really care what the data was. I care the fact that the bonds were actually up before the data came out. Then the bonds actually continued to go up. The bonds saw this coming. And one of the points is look, the bonds at the cash open, when I say cash open, that's when the marketplace opened, the bonds were already rocking basically when the cash open happened. And that was before there was any real sell side activity. I want to make that crystal clear. The bonds saw it. Okay, because you see the sell side activity today, you're like, oh, there was precipitous sell side activity. Yeah, the bell went off and we started selling off. Okay, yes, the bell went off, we started selling off. Meanwhile, okay, that bond market was already rocking to the upside. Like it was going parabolic. And again, that time frame of 6:30 in the morning, that's when the bell goes off, at least the time zone I'm in right now. The bonds were actually up, okay, just about almost a full point at that point in time. So it is what it is. And the bonds actually saw it coming. We're going to watch bonds very, very carefully in the next couple of days because, look, inflation was hotter than expected, but the interest rates actually went down because this right here, this is what I call duck and cover. The bonds rallying, okay, was capital actually, running scared. That was actually capital rotating out of the marketplace, and that is exactly what I was kind of calling it into question early this morning. I said, hey, look, these bonds. Okay, they haven't meant anything for the last couple of weeks, but all of a sudden they're back in play today. But the bonds unequivocally saw this move actually coming. Now, when I say get ready, another wave of risk is imminent. What else do I see? So obviously I saw the bonds move up. We're going to continue to watch that early next week. I saw volatility. Volatility jumped, okay, back into what we term backwardation. Actually, the backwardation is getting bigger as I speak right now, as S&Ps are actually right at or near lows. So here we have backwardation. You got the bonds that are up. What else do I see? Hedgers are stepping up into round two. It's not just one product over here. Okay, it's taking a look at like VVIX. So VVIX is the volatility of the VIX. I was explaining on last weekend's update and on Wednesday's update. Yeah, the VVIX got crushed back down because people were relinquishing the big institutions were relinquishing hedges. They were profitable on hedges. You get out of your hedges. Now they're re-upping, and this is a big move today. So it's definitely a big move in the VVIX, the volatility of VIX, which means that trade is actually stepping in right now and saying again, duck and cover. But this secondary move, it's not as violent, and it should not be as violent yet because we've already seen the movie before, meaning that, and I'll continually reiterate this because when you watch markets sell off like this, okay, it's constantly like watching this really, really bad movie. That's like literally what it is to me. You're like, lady, don't go in there. Like, how it's going to end. That's it. Again, it's like watching a bad horror movie. Oh, don't go in there, lady. Okay, there's an axe murderer. And when you watch this, the movie the very first time, okay, you're like, holy crap, I couldn't believe that. I scared out of my, but now we're doing it a second time. And the second time you see that same really scary movie, and it's been a while since I've actually explained this, but the second time you see the really scary movie, you're like, crap, I've seen this one before. Okay, lady, don't go in there. Oh no, you're going to get killed. That's the second time through. And that's what a lot of people don't read. They're like, well, the VIX is not cracked into new highs. And no kidding, it hasn't cracked into new highs. It's the second time you've seen something scary. Second time you see something scary, it's like, whatever. Okay, kind of shrug your shoulders. But I'm going to tell you something. You better pay attention to these moves. Okay, you better pay attention to these moves because, in my opinion, this is my opinion, these are big freaking moves for the second time through. They are. And that just tells me, like, ruh-roh, raggy. Now, hedgers are stepping up into round two. The next thing I want to cover over here is an opinion piece, and that is, come on, tariffs are just an excuse for sell-side activity. Okay, tariffs are an excuse for sell-side activity. Like, don't get me wrong. You're like, people get upset when I say stuff like this. Don't get me wrong. Stocks like GM, oh no, it went down. Okay, it went down. It's barely going down today. You tell me, how are those tariffs like, oh, they're really impacting like Tesla, a little bit of sell side activity. Come on, Tesla actually went up initially on the news. Okay. How are the tariffs actually impacting Microsoft, which by the way is cracking into new lows? Closes right here. It's basically matching lows. How's it affecting like Apple? Holy crap. How's it affecting Amazon? Well, come on. People are going to come up with stories over there, right? Meta. Oh no. Facebook. Okay. Those 25% tariffs are really going to impact. It's a bunch of crap. That's an opinion piece. It's a bunch of crap. It's an excuse. Look, all you had to do was look ultimately at a new IPO that came out today, and I'm not going to go into detail. An IPO came out today, like Nvidia had to actually support it. Meanwhile, Nvidia is going to need some support themselves over here. Look at the 5-year in Nvidia; it's starting to get actually scary out there. But tariffs are an excuse. There's sell side activity, and that sell side activity is unequivocally vicious. But it's not vicious, okay, where you would expect tariffs to hurt. It's vicious in like the Nasdaq. Okay, it's vicious in the NASDAQ over here because the NASDAQ is just, it's an overcooked turkey. And that's, again, the opinion piece over there is the tariffs is an excuse. And they're kind of masking, if you will, a degree of the risk in the marketplace. Now, what do we expect next week? Well, a lot of volatility next week. There's no question about it. Before I actually get into some of the trades, okay, I want to cruise back over to the SPX because the SPX is just dancing. Okay, got 15 minutes left. It's just dancing above the expected move. I've actually got a butterfly on. I'm up, just about 1,100%. But if I left the butterfly on right now, if I left the trade on, okay, it's got about $5, $6 profitability in here. If I actually wanted to close this thing right now, create a closing order, okay, I will put a closing order in, and I'm actually going to try to close it. Just going to work an order for like 715 right now, okay, and see if it actually comes into my zone over there. So I am working as you're actually seeing me record this video here into the weekend update. I was shooting for $10 or higher on this one, but I think I'd take $7 or greater into the close. But again, we'll see how it plays with just moments to go to the cash close. Anyway, in this particular regard, okay, in the SPX, before I even get into some of the trades that I've actually had on this week, I'm already thinking, of course, about next week, right? You're up to about $140 expected move. So things are going to get rocking out there. By the way, I'm just watching the volatility into the close over here. Yeah, we're getting crazy. We are getting crazy. So bear with me here for just a moment as I'm actually going to cancel it and wait. Okay, I'm going to cancel and actually wait for it. I'm going to take the full Monty of risk into the cash close over here. All right. Distracted? Absolutely. Why? Because I'm right on the dance floor of one of the bigger percentage trades that we've seen on a year-to-date basis, up 11 to 1,200% with just minutes to go to the cash close. Now, back to the SPX. So the SPX, once again, is projecting some pretty significant risk for next week, and rightfully so. Now, everybody wants to, they want to handicap what this marketplace is going to do, as I said to you, all right? You got a few things. You're going to look at the bond market. You come in here Monday, like the market reopens obviously on Sunday afternoon, but come in here Monday and these bonds are to the upside. I don't even care what the S&Ps are doing. Be afraid, okay? There is every chance that big news does break, in fact, this weekend. So my estimation is that we're going to be in the midst of volatility, literally, okay, right into Monday and Tuesday. Again, the idea of like that April kind of second deadline is whatever. It's dead to me. I don't really care about that. Obviously, we have to deal with, end of the quarter. And for those of you interested, at the end of the quarter, I'm window dressing, there's not going to be any real dressing of a portfolio over here. We're seeing sell side activity, so be mindful of that. Again, next week, though, some fairly extreme volatility, obviously pricing in over here. Coupled with that, okay, we are very, very close, okay, to a high degree of correlation. People, we're not home yet. And that's one of the things I really want to drive into you here towards the end of this video is that, okay, we're right on the cusp of seeing, if you will, that quintessential all down day. You need to see, okay, literally fund managers, retail, they got to throw in the proverbial towel. There's got to be no place to run to, no place to hide. We are still seeing, albeit small, pockets of strength. Okay. So long as there's pockets, so long as there's rotation, I don't believe that we have capitulation. Now, throughout the course of this week, I hit trades in Meta. Meta hit for 30%. The SPX, okay, I've got it listed twice in there, but the SPX, it's 500% trade. Okay, so in the account statement over here, I'm actually going to cruise in and type in SPX, just give you guys a quick run through on a couple of the trades that we did do. It's just 30 days back, but here's a trade. In fact, let me isolate this, make it a little easier to see. Okay, the trade this week, I paid 40 cents and 45 cents respectively. I'm out for 270, okay, on a portion of it. The other portion I'm actually still sitting on right into the cash close. JP Morgan, I'm on the dance floor, okay, for even more profitability, a number of trades in there, but I actually hit an intraday trade on JP Morgan, okay, for over 100%. Goldman Sachs, okay, the Goldman Sachs position right now is up some 31%, also very close to be on the dance floor for a close in here. EWG, FXI, XLV, everything that we're looking at right now, okay, is profitable. So again, what do we have next week? As I said, the place I always start is the place I finish, the SPX, okay? Another expansive amount of risk. So even though, okay, we have, and again, I'm going to reiterate this one, even though we have about $140, $145 expected move over here, okay, I think you need to anticipate every ounce of that. Don't worry so much about some of the news that's going to come out next week. Like I've already looked at the calendar for next week, okay? Don't worry nearly as much about the employment situation, okay? The JOLTS data, the ADP report, the factory orders, okay? It's, again, kind of masking, if you will, some of the volatility that's originating specifically from technology. Where I would also watch an incredible amount into early next week, the financials. Okay, and here has had a phenomenal recovery. Today, getting absolutely, okay, decimated, but they're still, okay, only down nominally on the week. If there's good place that there could be follow through sell side activity, people, I'm telling you, watch these financials early on in the week. As I said, again, watch bonds, okay? Bonds are up. It's definitely a sign of duck and cover. Our volatility is back to backwardation. The S&Ps are down 115, but we did not cross through new lows. I think you need to anticipate some point next week, you're going to see just that. Thanks everybody for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.